The WNA Global Equity Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $1 million with a 100% equity objective. This is a new composite that was previously marketed by WNA. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account that is under $1 million. These accounts are added to the composite at the end of the month that the value meets or exceeds $1 million. 3. Any account that is not invested in accordance with the WNA Global Equity Model, i.e. large cash positions on new accounts, addition of non-equity components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $1 million, unmanaged assets are brought in, or the investment objective of the client is altered. Past performance for these accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. As is the case with all investments, the potential for profit is accompanied with the possibility of loss. A description of the equity indexes listed for comparison in the table provided in the presentation are provided herein. The S&P 500 is considered a broad index for the equity market, seeking to represent the returns of the top 500 publicly traded companies. The MSCI EAFE is a market capitalization weighted index, maintained by Morgan Stanley Capital International, MSCI, which includes a selection of stocks from 21 developed markets, but excludes those from the U.S. and Canada. The Russell 2000 is a small-cap stock market index of the bottom 2,000 stocks in the Russell 3000. It is the most widely quoted measure of the overall performance of the small-cap to mid-cap company shares. The MSCI Emerging Markets Index is a market capitalization weighted index maintained by Morgan Stanley Capital International, MSCI, designed to measure the equity market performance across 23 emerging markets, EM. The MSCI ACWI Investable Market Index represents more than 9,000 securities across large, mid, and small cap size segments, and across style and sector segments in 46 developed and emerging markets. The WNA Global Fixed Income Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $500,000 with a 100% fixed income objective. This is a new composite that was previously marketed by WNA. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account under $500,000. These accounts are added to the composite at the end of the month that the value meets or exceeds $500,000. 3. Any account that is not invested in accordance with the WNA Global Fixed Income Model, i.e. large cash positions on new accounts, addition of non-fixed income components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $500,000. Unmanaged assets or non-modal assets are added, or the investment objective of the account is altered. Past performance for the accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. The composite may or may not be the actual allocation determined to be appropriate for any individual client, and a client may or may not follow the composite. Clients with the allocation shown may have different results based on capital flows, timing of rebalancing decisions, fees charged, or other factors. As is the case with all investments, the potential for profit is accompanied with the potential of loss. The index used for comparison is the Barclays Capital Aggregate Bond Index. It is a broad range index that represents the total return of the bond market. It covers most U.S. traded bonds and some foreign bonds traded in the U.S. The index information is supplied to WNA by a third-party quotation service. Investors should note that investments cannot be made directly into this index. The Leuthold presentation is not a solicitation or offer to buy or sell securities. The Leuthold Group, LLC provides research to institutional investors. It is also a registered investment advisor that uses its own research, along with other data, in making investment decisions for its managed accounts. As a result, the Leuthold Group, LLC may have executed transactions for its managed accounts and securities mentioned prior to this publication. The information contained in the Leuthold Group LLC research is not, without additional data and analysis, sufficient to form the basis of an investment decision regarding any one security. The research reflects the Leuthold Group LLC's views as of the date of publication, which are subject to change without notice. The Leuthold Group LLC does not undertake to give notice of any change in its views regarding a particular industry prior to publication of their next research report covering that industry in the normal course of business. The Leuthold Group LLC may make investment decisions for its managed accounts that are inconsistent with or contrary to the views expressed in current Leuthold Group LLC reports. Whedon Investors LP, Whedon & Company LP's parent company, owns 22% of Leuthold Group's securities. A managing director of Whedon & Company LP is a member of the Leuthold Group LLC Board of Directors. Whedon & Company LP, member FINRA, NASDAQ, and SIPC.
You know, I'm the one who ordered this platform, by the way, so you can all see me up here. But anyway, you know, I still remember the day last fall when Mark called up to ask me to participate in the event. You know, I was still, it was the night after one of the big Republican debates. I mean, the whole field, 16 people, you know, the JV and the senior debate, I watched the whole thing. So the next morning, and I'm still coming down from the high of that, and Mark calls me up. He said, so I'm still in this political mindset. He said, hey, Doug, do you believe in free speech? I'm like, yeah, well, yeah, of course. He said, well, good. How about giving one? But, you know, in reality, Mark, no need for you to trick me to come down here. Delighted to come down and speak on behalf of the Leuthold Group. You know, we've been partners now with Waddell. Hard to believe, time flies. You know, as they say, raising kids, long days, short years. The same, I think, is true with managing portfolios, but it's been 5 years, and in fact, when Waddell came on board in the Global Fund, and again, we're a defensive capital manager, so this is the type of thing, you know, he showed our sort of down market protection. It was a similar thing. Waddell came on board, within 3 weeks, the market was down about 15%. So I think you bond together in tough times, but it's come up on 5 years. Delighted to be a partner with Waddell. I certainly appreciate their global perspective, and we feel sometimes, we've had this global fund now for 8 years, and you know, we feel like maybe we're a little bit ahead of the curve and thinking more globally. So it's good to come down here and hear David's thoughts, you know, sort of from a kindred spirit that, you know, it's going forward, I think it will be critical to look at these global risks and global opportunities. So we certainly appreciated David's thought leadership on that score. Just a quick, this is a Waddell event. It's not a Leuthold commercial, but we do manage assets, and we may be better known nationally for the institutional research we put out. As a matter of fact, I was a Leuthold research client for 15 years before I came on board Leuthold, but we put out this green book. We're not too savvy when it comes to marketing panache, but we've been putting this out for 36 years now. And in the back there's a joke section, and each month there are at least a couple that really shouldn't be shared in a mixed audience. So, you know, naturally for years I would go home and tell some of those jokes to my wife, and, you know, not too long ago I mentioned to my wife, you know, honey, remember all the years, you know, reading the research at the Leuthold Group? Did you ever in your wildest dreams think that I would be working at the Leuthold Group? She said, you're not in my wildest dreams. David earlier on showed a slide that was similar to this, and it really just, and maybe I'm just trying to rationalize because we are asset allocation managers, but last year, from a couple perspectives, was arguably the worst year for asset allocation in recent memory. This chart goes back to 1973, and what we're looking at here is the performance of 7 assets. We do a lot of quantitative work on sort of this group of 7 assets. So U.S. large company stocks, U.S. small caps, EFA, which would be foreign developed stocks. There's a long history for those. That's why I've included those in the study. REITs, commodities, gold, and treasury bonds. So we asked the question, what if an asset allocator coming into each year had perfect foresight and could allocate all of his or her assets into the best performing asset class for the coming year? What would be the performance result? Well, historically, that would have given you about a 35% annual return. So perfect foresight or clairvoyant asset allocation. Well, the return last year was the worst ever. The best return was REITs at 2.2%. So even if you had a perfect vision of what was going to happen in 2015, there was almost no payoff. Now let's go to the other extreme. Let's say instead of having perfect information or perfect foresight, you had none, and you just said, hey, I'm going to take those 7 asset classes, I'm just going to put 1/7 of my assets into each one of those and call it a day. Just spread all my risks around. It was also a very bad year for that strategy. An equally weighted portfolio of all 7 of those asset classes was down 6.2%. So the only return historically that was meaningfully worse than that was in 2008. So either way, I'm just saying, look, if you had perfect information and picked the one best asset class, or if you had zero information and spread all your risks across the 7 baskets, either way, it was a really difficult year or for someone with an asset allocation approach. In terms of whether this is an equity bear market, in our shop, we don't like to get hung up on labels. What I've got here are the returns for several prominent indexes, and keep in mind this is through last Friday, so this is after a stock market bounce of 4 to 6%. What we've got is the 2 usual suspects. I mean, these are on the headlines of every newspaper and on the nightly news. These are the 2 big indices upon which most U.S. investors focus. Down only about 10%, and again, that's after a rally of 4 or 5%, so they were down around 14% at their lows. But that is so misleading as to the damage that's already been created by this, we would call it a global bear market. And we're not going to get hung up on whether the Dow and the S&P ultimately fall 20% or not. The thing I think to focus on is the damage that's already been created. And keep in mind, this is after a 4 to 6% bounce. You've got mid-cap stocks still down 16%, small company stocks down 22%. We'll skip down here to the value line arithmetic. That's sort of the average company in the U.S. Rather than taking the massive market capitalization of an Apple computer or an ExxonMobil. This just is sort of the average stock. That, after a big rally in the last week and a half, is still down 18%. And even within the S&P 500, and the S&P 500 down only 10% right now. Within the S&P 500, volatile stocks, so this would certainly be energy, other commodity stocks, cyclical stocks, like a Caterpillar tractor or a Deere, maybe some of the biotechnology stocks, some of the smaller technology stocks, down 30.3% have just been trashed. And then outside the US, again, after a pretty nice rally in the last 10 days, the world ex the USA down 21% and emerging markets down 33%. So this has already been a global bear market. And whether we go down and break through those lows and get the Dow and the S&P down 20%, I don't know if that will happen. What we're getting to focus more and more on is just the value that this difficult market of the last really year and a half, almost 2 years, has created. So here's just more, if that hasn't impressed you enough, this is what's going on in the average European market. So these are the actual major index in local currency terms for all of the major European markets. The average peak to trough loss now in those European stock markets has been 29%. And that's in their own individual currencies. So David talked about the tremendous rise in the US dollar in the last year and a half, coming up on 20-21 months. When you layer that on top of these losses, there have been, for US-based investors, the losses in European equities have been very large. And here's a similar look. This is just Asia Pacific. Again, looking at their own respective markets in local currencies, the average loss in that region has been 26%. So when you factor in a strong dollar on top of that, the losses to US-based investors have been over 30%. The good news, all of that's sickening. I hope you've all digested your food. It's not great news. But the good thing is, I'm going to skip over that in the interest of getting through everything here. The good news is we've created much better valuation. Somewhat so in the United States. but much cheaper valuations overseas. And what I want to start with here, David talked a little bit about, if you remember back to 2014, it was 25 months ago that the Fed embarked on this, what we argued at the time was in fact, a tightening program. Remember, he had the quantitative easing, this money printing that took place in 3 different phases. Well, what happened over the course of 2014 is that was leveled off. You came into 2014, into January, with the Federal Reserve coming into the marketplace and artificially buying $85 billion of US Treasuries per month. That's 0.5% of GDP of artificial demand propping up the bond market. And clearly that was working to prop up the equity bull market. But what happened over the subsequent 10 months is you went from $85 billion per month, you ratcheted that down in 7 steps to 0. So what happened, and I will go back to that previous slide here real quickly, you've got the S&P 500, that's the jagged line, and then this sort of smooth line underneath it, that is the total assets of all Federal Reserve banks. So look at the high correlation, and this is when the whole quantitative easing program started. You know, the Fed, the Committee to Save the World, back in the fall of 2008, when the Fed balance sheet was only about $900 billion. Oh, I'm sorry, pressed the wrong button here. So what happened? They immediately embarked on this massive purchase of Treasury securities. The stock market, now whether this is correlation or causation, I guess it can't ever be proven one way or another, but the stock market basically rode that expansion in the Fed balance sheet. And here's the problem, is that now in the last 15 months, because this whole program of quantitative easing ended 15, 16 months ago, that's exactly when we started to run into all these problems. And it lines up exactly with that entire sequence that David showed of unintended consequences. Stronger dollar, weaker commodities, problems in the emerging markets. All of that, we think, traces back not just to the one official Federal Reserve rate increase that we had 2 months ago. The problems actually started 25 months ago. But again, the good news is that has knocked down valuations in the US and around the world. What we're doing here, we like to analyze what's going on above and beyond like the Dow and the S&P 500. So we've got a universe at our shop we call the Leuthold 3000, and it's the largest 3,000 domestically traded stocks on the US market. So that includes some of these ADRs, the big foreign companies that list on our own US exchanges. So it's about 300 ADRs and 2,700 domestic stocks. 25 months ago, the typical PE ratio on that group of 3,000 US stocks was close to 29 times earnings. And you know, that sounds high. I'll get into the weeds here for a moment. What we like to do with earnings is not look at what a company is going to make this year or what it made last year. Because the economy and because earnings are cyclical, we like to smooth out earnings over the last 5 years. So we just take a simple 5-year average of earnings and we call that normalized earnings. It just gives us a better measure, we think, of a company's earnings power. But at any rate, you've taken that typical stock's PE ratio from near an all-time high, January of 2014, and exactly the same month, and I don't think this is a coincidence, it's the same month that the Fed started this program of tapering, of leveling off those bond purchases. So just as that started to happen, valuations started to come down, and the good news is you've taken those valuations down from 29 times earnings to about 21. And I mean, this was the absolute low of March of 2000. I certainly don't think we're going to get anywhere close to that. You know, we could sell off further, but the good news is the US market, which is held up better than any other market in the world, is no longer, at least the typical stock in the US is no longer overvalued. Here's a look at that. This is the same chart. We've just put some zones around it. And the way we look at valuation, you know, I always chuckle when you see these Wall Street strategists that get on TV and with a straight face say that oh, we think fair value on the S&P 500 is 2043. You know, valuation is a longer term concept. We don't get worried about valuation unless it gets exceptionally high, which it did a couple years ago. But what we like to see is that values range within these two bands, the 30th percentile historically and the 70th percentile on the high end. In other words, there's sort of a big wide trading band where you really don't have to be all that concerned about valuations. The good news about the correction of the last year or so is, again, that you've taken valuations down from almost 29 times earnings, and you're around 21. So you're almost in the bottom third of valuation zones over the last 30 years. So that's good news. Now here is where there are some risks. And the people I think that are most exposed to these risks are the ones that have bought into this sort of passive indexing on US stocks where you just put your assets into an index which is heavily weighted in the largest companies in the US. The issue is those are the companies that right now possess the greatest valuation risk in this market. So it's a little different valuation ratio than a price to earnings. This is just price to sales. What's the total market capitalization of this S&P Industrials Index relative to all the sales that it generates? It's still very high. And this is really just a handful of the big, more than a handful, 50 big multinational stocks that are propping up the US market, the S&P 500 and the Dow. Everything else, as I've showed, has really gone through a conventional cyclical bear market. So we think, this might be the last shoe to drop in the US. But the good news is, looking beyond those really big companies in the US, and especially looking overseas, they're much more attractively valued markets in which to be invested. Here's the US, this MSCI USA index. This is sort of just like the S&P 500, is trading at around 20 times earnings. Here's the rest of the world outside the US. It's trading at 14.3. And then here's emerging markets, which I agree is going to be a great turnaround candidate. And maybe we have another leg down to new lows in this market. I'm not certain about that, but you've got emerging markets which are growing dramatically faster than the United States, that have better demographic characteristics than the United States, trading at just half the PE multiple. And consider that things really, from a global perspective, have been pretty good in the United States. 4.9% unemployment. We have near record high profit margins. So here we are paying 20 times earnings for earnings that are in pretty good shape. The earnings in much of the rest of the world, in Europe and Japan, are depressed, and the earnings in the emerging markets are also depressed. What I'm getting at is the valuation gap is probably even wider than what we're showing here. If you assume that US profit margins are going to come down somewhat and that they come up around the rest of the world, then there are really some great bargains that have been created around the rest of the world. So how we're positioned now, I didn't get into a whole lot of the mechanics of what we do. We're a tactical manager, so we can shift our net equity exposure between 30 and 70%. We're about 42, 43% equities right now, just waiting for some of our models to line up. I do expect an opportunity later this year where we're going to go to that maximum equity exposure of 70%. It may be sooner rather than later. But at any rate, what we do, and this is getting into maybe a little bit too much into the mechanics, we have 53% in long equities, and then we have a 12% equity hedge. We actually short stocks quantitatively. So we're looking for expensive stocks with deteriorating business fundamentals. So 53 minus the 12 gets us to 41%, and this changes day to day. Since I put together that slide, we've had a nice rally, so we're more like 43, 44% equity exposure. But again, I think things are shaping up that we're going to be able to go back to sort of a fully risk-on exposure position and buy some of these global stocks that have been marked down so much.